All right, guys, we've got a lot to talk about today. The Fed, inflation, the outlook, many things to discuss. And I'm going to make this as brief as possible. I'm going to walk you back through what happened on CPI inflation day when we got that 7.1% print. It was very critical, and it was also very insidious. And I'm going to share with you what's going on. In a note to members, in an email that I sent, I wrote that when the CPI data came out at 8:30 a.m. for inflation, I witnessed that the volume that caused that large pre-market spike, it was incredibly light for such a macro event. But more importantly, with this data, I knew that transactions at the 4,100 level and above would likely be thinly traded, and I promptly told our friends that those levels were most likely not sustainable. And what did we see that day? If you remember, we saw a massive fade, and that was an omen of what is to come. Now I'm going to discuss the FOMC, and this is where it gets really critical. I watched the entire press conference yesterday. I listened to the entire Q&A, and here's what I came away with. First, a summary. So the Fed, they raised rates to 4.25 to 4.5% Fed funds target rate. And they're going to try to keep rates at 5.1% for most of 2023. Now, I listened to the entire presentation by Jerome, and it was very hawkish. Look at this fact here. He says that 7 out of 19 members see rates above 5.25%. Now, guys, I want to let you know the severity of that statement right there. I personally don't think that the Fed is going to have the willpower to keep rates above 5% for all of 2023. But if they do, we're going to see a screeching halt in demand come through for cars and housing. These two sectors will almost not be allowed to grow with this restrictive policy that we have here today. I mean, I recently took out a car loan because I'm going to be getting myself a new car. And guys, I've got great credit and I have a really solid background, and my interest rate is north of 7% on a new car. North of 7% with good credit. So think about it this way. If someone has not so good credit and they're buying a used car, they could be looking at 10, 11, 12% interest. In my mind, that is just absolutely insanity. Another thing that I think is outrageous is that the Fed thinks that the job market is really strong. They can't possibly believe the job market is strong. Let me explain why. The Fed uses non-farms payroll, NFPs, in order to give you a summary of how hot the labor market is. The problem is, the way NFPs are calculated is that if one person works 3 jobs, the report is going to indicate that 3 new jobs were created. But if people are working multiple jobs in order to make ends meet, then those 3 jobs are not actually high quality data points to signal a hot job market. We got to be very careful. In fact, I wrote an email publicly about 8 charts to pay attention to and inform your 2023 investment strategy. So make sure to check that out in the description below. I'm doing everything I can to help you guys survive, navigate this market, and we've done tremendously in terms of our maneuvering. But more on that later. Here's something that I want to share with you. I believe that if the Fed follows through on their intention to leave rates at 5% or above for most of 2023, I believe that unemployment could tick up to over 5%. It might tick up to over 6%. And you might think that's not significant. But please allow me to remind you that during the peak of COVID, where it was a complete pandemic, unemployment was around 14%. So if we have a situation where we're not in lockdown and we're not in a pandemic anymore, and you have unemployment at 6%, maybe 7%, that would be catastrophic for the economy. And so what I would highly encourage all of my friends listening to my videos, reading my content, what I would encourage you to do is whatever role that you're working in right now, even if you're not getting paid to work overtime, I would encourage you to put in the additional hours, put in the additional productivity to keep your job as much as possible. Because in corporate finance, productivity is profitability. So if you're very productive at your job and you do really good work for your team, you're going to be indispensable for the company. But if productivity is low, output is low, and profitability for the company is dropping, then job security is on the line here. And the only way to take advantage of all the deals that will happen in real estate, in stocks, in everything else that you want to invest in, it's only possible if you have a very strong source of income. So whatever you do, now is the time to up-level your skills, to upgrade your ability to serve the organizations and the clients that you're working with. And if you do that right, we're going to see a dramatic reset where a lot of the opportunities are reshuffled to people who are prepared. So mark my words, for those of you who are prepared, the best is actually yet to come. For people who have not been putting in the work, I would say the worst is yet to come. Now, I want to talk about Tesla for a moment. And the reason I want to talk about Tesla is that it represents a very important part of the US investor base. In fact, besides Apple, Tesla is one of the most popular retail stocks, not just in the US, but globally. And we remember that back in 2020, 2021, Tesla minted a lot of millionaires, okay? In fact, this cohort of Tesla millionaires is probably responsible for a good number of luxury real estate purchases, for a good number of Tesla purchases, for a good number of other high consumption purchases. But with Tesla being down 50, 55, 60% this year, this cohort is most likely becoming very fearful. And what that means is that every single investor group that has had its time in the sun, BTC, NFTs, the China trade back in early 2021, Tesla back in 2020, 2021, even oil earlier this year when it was above 110, every investor group has gotten targeted by the bear market. So I know that it might sound like a broken record, but it is so important to preserve your capital right now so that when the real catastrophe happens in markets, you're absolutely prepared, you are liquid, and you have the mental and psychological strength to act. One of the things that I really stress, not just on my channel, but inside my community, is not just research and strategy. Research and strategy is just one part of the battle. The other part of the battle is execution. And in order to execute, in order to hold during this intense market volatility, the only way to do it is to be liquid. If you're not liquid and people are overexposed in the market, it doesn't matter how good the research is, how good the strategy is, being overexposed is going to allow volatility to shake you out. So if there's anything that you take away from execution, one of the core aspects to help you with execution is to be liquid. All right, guys, with that said, make sure to join me on my email list down below. I send out lots of previews for my exclusive content. I share as much insight as I can while also trying to build an awesome community for everybody. So great public content for all and also great premium content for my friends inside. Follow me on Twitter, follow me on Instagram. I'm developing a new powerful investment strategy that I will showcase in 2023 that allows me to take advantage of multiple market conditions. Follow me on Instagram for sneak peeks where I post it on Instagram stories because I don't want to really reveal this until 2023. With that said, guys, make sure to stay safe in the markets and I will see you in my next video.